like to bring in our featured guest of the morning to continue the conversation. He's John O'Connell, Chief Executive Officer of Davis Ray. Thanks for coming in.
Thanks for having me, Paul.
What do you think of this dramatic collapse in the price of crude oil, so important to Canadian stock markets?
I'm not super surprised. It's looked for a while, ever since people have been wanting the market to go higher with all the different disturbances. And when a market doesn't react the way it's supposed to, you have to look for fundamental reasons for the weakness. And as I've been saying to some of my friends out in Calgary, oil looks like it has a 6 handle on it for sure. Depending on where the economy goes later next year, it could have a 5 handle on it. I think Julian, framed the argument very well. The American energy producers have been talking about financial discipline. The Canadian producers always talk about discipline, but go about their own business as it is anyways, with misaligned incentives and those kinds of things. My sense is that the oil and gas business is full of very, very smart people. And they continue to get innovative and more efficient. American production is going up, and it's going up with fewer rigs. So something's happening out there, which is clearly adding to this problem of slower economic growth and activity around the world. I was at a Christmas party a couple of days ago and talking to somebody who's involved in the distribution of fuel oil in Ontario, and it's down a lot, which makes sense because I think Canada's in a recession right now. But in the States, the other thing that's going on is you have these consolidations taking place and mergers taking place, because if you're not going to drill, you got to go out and buy the reserves somehow, and if you have good cash balances. So I think as you get these mergers that take place, financial pressures, you can only make so much in efficiencies and reducing cost. Financial pressures will build to keep production growing. And so I think in the American situation, it's going to be problematic for the Middle East. The Middle East has their own issues going on in terms of agreeing on how much production cuts somebody will do. So I think it's typical. Everybody said you got to buy energy stocks. Now they've turned into be not the right place to be.
Are they not the right place to be, though? The index is down. I ran the numbers early this morning. Since the end of September, the index of energy stocks has outperformed the price of oil by 24%. So it's come down, but it's held value relative to the price of oil. And the big bull case, we're almost out of time here, but the big bull case is that many of these big Canadian producers, once they reduce their debt to target levels, which they are very close to doing, are going to return a ton of free cash flow. Sometimes, in some cases, all of it to investors. In the case of in the form of dividends or share buybacks.
Yeah, I think they may do that. We'll have to see where oil goes. I think the average Canadian producer probably needs around $80 to actually be able to economically, on a full cycle basis, replenish what they sell. So I think you're going to see some pay downs, but I think you'll start to see, if this weakness elongates, I think you'll see more modest returns of your capital. I mean, don't forget, people sunk a lot of money into these energy companies, and now they're going to give it back to you in a taxable format. It's not necessarily the best strategy to put your money into something and then get it back in taxes.
Okay.